And just some, I guess, administrative issues first. There is on the right-hand side on the panel, each one of you can see on your screen, you have a couple of handouts. One of them is basically our presentation with the bios for our panelists. You will also see a handout that Professor Byrnes prepared for us, answering many of the questions that our members submitted and that our other attendees submitted. So with that said, there's also a chat and there's also a place where attendees can actually submit their questions. So feel free to use that during the next hour if you have any comments or questions that you'd like to ask our panelists. We have tons of questions. I don't think we'll be able to get through all of them, but we'll do our best. Okay, so let me first introduce our moderator. Our moderator is a TaxLink member. He is Marc Enzi. He is an enrolled agent, a certifying acceptance agent, a certified financial planner at Tax Solutions in Houston, Texas. He's a Treasury licensed enrolled agent. He has his primary focus is on tax controversy matters, international tax consulting, FATCA compliance, and expatriate and rotator population tax compliance. I'm going to hand it over to Marc. He's going to introduce the panelists, and then we're going to get together with our discussion. So,
good afternoon, everyone. Thank you, Matteo. I'm Marc Enzi, and our panelists today are Mr. William Blum in New York, Professor Byrnes with Texas A&M in Dallas, and Mr. Robert Ladislaw in New York, and Mr. Haydon Perryman in London. So good afternoon, good evening, everyone. And with that, we've got a set of questions here that have been listed, and the first one is pros and cons of FATCA. Well, the cons, that's a controversy. Not too many people are happy about it. The pros are asking about what's the benefit to IRS or U.S. Treasury for FATCA. And I'll simply state it. I think it's going to bring in more tax money, but I'll let our panel answer that. And Mr. Blum, would you like to start?
Sure. Bill Blum, I'm a partner with the law firm of Solomon, Blum, Heymann in New York. We practice international tax law and have, since we formed the firm about 20 years ago, I've done it myself even longer. On the subject of FATCA, pros and cons, yeah, I think there's a little doubt that it will bring in some more revenue, although if you read some of the studies, it's not clear how much. And I think that it's important to note that in some respects, at least, it's really a deterrent for those who, I mean, if you look at the state of offshore banking, for example, 20 years ago or even 10 years ago, you compare it to today, especially since FATCA, people who would otherwise have put their money in secret offshore accounts are certainly deterred from doing so. And we have our share of clients who had money in offshore accounts, maybe not even necessarily for secrecy, but who approach us on a regular basis for advice as to how to, quote unquote, come clean and comply with the law. So there are a lot of effects. Not all of them good, but not all of them bad either.
All right, and do any of our other panelists have anything to add to that?
Yeah, sure, Mark. It's Haydon here from London in the UK. My own personal opinion is that FATCA won't bring in any money for the IRS, and I do mean any. So yeah, I mean maybe $1 million or so, but in terms of real money, it won't. The reason I say that is if you look at when the Hire Act was passed, so FATCA's Title 5 of the Hire Act, it was said that 8.7 billion would come into the US Treasury, but that was from withholding, and the vast majority of countries have entered into IGAs under which there will be no withholding. So I would say, to oversimplify, no income whatsoever for the US from FATCA directly, but they may get some more from things like Chapter 3, from people being brought into compliance, but not from FATCA directly. The main benefit, if indeed it is a benefit, is that they'll have more information on US account holders outside of the US. So for me, no money, not in material terms.
All right, very good. Thank you, Haydon. All right.
William, I'll jump in, and I'm sorry, my video will restart in a second, but I agree with Haydon. I've done a study, in fact, with him. and you'll see it on my blog, where I have done empirical analysis going back 2 years, looking at both the number of taxpayers that we reasonably believe were non-compliant pre, let's call it 2009, the number of taxpayers who are reasonably non-compliant as of today. We most recently published that empirical study on the Cayman's Financial Review, I think. And then finally, the amount of revenue to about a $10 million mark that we think will be brought in yet to come. I mean, obviously, we know how much has been brought in from individual non-compliant taxpayers. The IRS has reported that to be about, let's call it $6.5 billion. But I think it's relevant, and I think the other panelists will talk about this, that it's relevant to discuss that most of the revenue that's been brought in is not tax revenue. In fact, about 80% of it is financial crimes revenue under a very different title of the U.S. code system, money and finance, and that's the FBAR, which I'm sure that many of the listeners are going to be interested in today, but the FBAR and its penalties, and then of course the IRS has recently addressed how to ameliorate some of those penalties going forward. These are different from the tax question of noncompliance, and that's all I'll say right now.
Okay, thank you, Professor Blum. All right, on to the next question. We have many foreign banks have now identified or tagged clients as U.S. nationals. Many of these U.S. nationals abroad have no links to the U.S. and have no plans to return to the country. What kind of consequences can be expected for identified U.S. nationals that have decided not to disclose or report their foreign assets and income to the IRS? Are there any agreements in place or examples of foreign authorities enforcing noncompliance? And I'll take that one back to the professor. Can you talk to us about some of the penalties for noncompliance?
Well, okay, let's first say let's domestic, so for U.S., and then let's look at foreign, and I'll do it quickly. But for domestic, we really have two types of penalties when I say tax and non-tax. Within tax, there are obviously a subset of penalties also. There's your non-compliance penalty, then there's your super non-compliance penalty, let's call that the 75% and above. There's your normal income tax penalties versus your FATCA penalties on the withholding agents. So that falls under the realm of tax penalty. Separately, and then there's interest, of course, and so forth. On the non-tax penalties, which are really where the focus is for individual taxpayers, that's the FBAR, primarily the FBAR penalties. Those non-tax penalties, and the courts have upheld this to some degree, there's a 50% per year of the assets in question that are subject to the penalty, and there's a really interesting case, and I'd love to hear the feedback from the attorneys on the call, but a really interesting case is the IRS went for, let's call it as we all know, they can go back 6 years, that's 6 times 50% is a 300% penalty, and the IRS went for that, and then they had settled down to 150% penalty, and the court said that is too egregious under the U.S. Constitution, and the IRS settled it out for just the full value of the assets of the account. And so that's a very recent holding in the last couple months. And but that penalty, that 50% penalty, is bringing a lot of non-compliant taxpayers and foreign banks to, let's call it, compliance. And I think somebody else can talk about it. I don't want to take all the time, so somebody else can talk about the different avenues of entering the OVDI program and how the foreign banks from Switzerland are addressing it through the Swiss non-prosecution agreement program.
Okay, thank you, Professor Byrnes. Next, Mr. Ladislaw. I apologize, I didn't get a chance to introduce you properly. Would you like to comment on the professor's, on that previous question, and talk to us a little bit about?
Sure. Just going back to Professor Byrnes' point about that case where the court found the penalties excessive under the Constitution, the IRS actually reacted to that as they had to by issuing a notice. And now, for the most part, on examinations, the IRS will not be imposing penalties of greater than the account value that was not reported. In other words, prior to that case and prior to this notice, as Professor Byrnes stated, the potential penalty was 50% per year, so we could be charged in penalties a multiple of the total account value that wasn't reported. But the IRS has now come out and said they're going to follow that case essentially and not charge penalties for more than the entire value of the account. They, of course, reserve the right to impose a higher penalty in certain cases, but for the most part, they're going to follow that format with respect to penalties, FBAR penalties. And that's in the case of a willful failure. When you're talking about FBARs, there's willful failures and non-willful failures. And this 50% penalty we're talking about per year, now limited to up to the value of the account. We're talking for willful failure, and that's where the IRS actually proved that the person intentionally did not report the account pursuant to the FBAR regulations. Now, going back to the question of how do taxpayers come into compliance before they get contacted by the IRS, there's a couple of different avenues. The most expensive one is going through the offshore voluntary disclosure program that the IRS has in place, and that is appropriate for people who did in fact act willfully to who acted willfully to try to hide their assets and didn't file forms and didn't declare the income on their tax returns. It's appropriate for those people to enter the offshore voluntary disclosure program because in general, if they don't, the penalties can be even higher than going into that program, and criminal prosecution is even a possibility. In that case, in the offshore voluntary disclosure program, the penalty on unreported foreign assets is 27.5% of the highest balance during the tax returns, going back 8 years and paying your back taxes, plus a 20% accuracy-related penalty, plus late filing penalties, interest. So it's expensive to go into that program, but the idea is it's not as expensive if they catch up to you first and throw everything they can at you. Now, if you're a non-willful failure to file person, meaning you basically just made a mistake or you didn't know the law, and this type of remedy is really most appropriate for citizens, example, who have lived overseas for many years and they just didn't know that they had to continue to file U.S. tax returns because we have citizen-based taxation. These people didn't necessarily know that they had to file U.S. tax returns in these FBARs, and in fact, the IRS wasn't even enforcing FBARs until 2008 when they started investigating UBS, which triggered everything we're dealing with now. And so for those type of people, those non-willful people, the IRS has what they call a streamlined program where if you live outside of the country, you can go back and file 3 years of tax returns and 6 years of FBARs and suffer no penalties. You just have to pay your back taxes, and if you owe any interest on the tax, if there's any interest applicable. Now, when you file that filing, you do actually have to include a narrative statement of facts explaining why you didn't act willfully. So, for example, if somebody in the UK were to just file under the streamlined program with a one-sentence statement saying, I did not act willfully to avoid filing these forms, that's not going to cut it, and the IRS is probably going to come back to the person in that case. So it really requires a narrative statement of facts. And the only thing I'll say with regard to the streamlined program, the only other thing I'll say is it's also appropriate probably for green card holders who live in the United States, because green card holders are often not aware that once you have a green card, in other words, once you're a lawful permanent resident in the United States, you're required to declare all of your income on your personal tax returns worldwide and file FBARs. Now, that's not necessarily intuitive. We're one of the few countries that actually has that requirement. So, yeah, but the streamlined program is potentially will potentially be useful for that type of taxpayer as well. The green card holder that just didn't know that they had to declare their income worldwide and all of their assets on the FBAR.
And that would include green card holders who don't live in the U.S. Although if you have a green card, you're supposed to live in the U.S., but many don't. That's
correct. Many green card holders, I'm sure Haydon can attest to this, to actually live in the UK and other places. But even if you live somewhere else, if you have permanent residence, if you have that permanent residence card, you must file your income tax returns with the IRS and declare all of your income worldwide and file the FBARs.
Okay. Hey, thank you, Robert. We appreciate it.
I'd like to add in some practice notes. Yeah. So I think everybody who's been involved in it, and remember, I'm not a practitioner. I'm an academic who talks a lot with both government and practitioners. So I'm not advising. I leave that up to my colleagues William Blum and Robert. But from the IRS perspective, who I do get to talk with a lot as an academic, I mean, I've literally heard this quote: "There is a special place in hell," that's the quote, for people who do a soft landing or go under the radar screen and file a quiet amendment to their past returns instead of using the OVDI program. But to counterbalance that, the OVDI program, until very, very recent with this new streamlined, more expanded approach, has not been effective, and certainly smaller taxpayers are harmed by it, and they haven't been allowed to amend their OVDI to take advantage of the new streamlined OVDI, and that's bad for them. But under the new OVDI, there is although obviously the IRS is reviewing each of the submissions, there is still a lack of manpower. And what I've heard, scuttlebutt now, I'm not giving an opinion, but what I've heard is that as long as the documentation is done by a lawyer, U.S. lawyer, not a foreign lawyer, a U.S. attorney who has a tax background, your documents aren't going to be the fine-tooth audit. If somebody doesn't do that and they give the sloppy where the IRS needs to come back with some kind of IDRs, you're going to enter that special place of hell category. And what the IRS is going to ask for, and this is going to screw most foreign people, they're going to ask, when you submit to your CPA to do your tax return and they give you that 80-page information document asking for everything you have, we've all gotten it, many of us throw it away. If you filled that in, submitted it back to your CPA or your tax filing firm, and you you marked no where it had the foreign assets or it said not U.S. connected, you actively marked no, they will use that against you as evidence of your willfulness. I heard that firsthand. So it's an interesting perspective, and why one should go talk to their attorneys when doing the streamline program.
Okay, thank you, Professor. That's good insight. Next on the list we have, in the case of, and this one's going to go to Mr. Haydon Perryman, in the case of U.S. nationals who haven't lived in the U.S. for over 10 years, for how long are they under obligation to report their income to U.S. authorities under FATCA regulations? So, Mr. Perryman, I imagine you probably have more than a few UK folks who've either got a U.S. passport but lived their entire life in the UK, or maybe have a green card but they've left the U.S. years ago and have been living in the UK continuously. Can you talk a little bit about that?
I can. So the answer to your question, or the question, is indefinitely. And people often look at me askance, like I've stolen from church, when I say that, but it's an issue here of US citizenship. And as long as you are a US citizen, whether you have to pay taxes depending on your situation or not is not really the issue. You have to file a tax return even if you don't have to pay, you have to file a tax return to the US, even if you don't have to pay taxes in the US, and you are paying taxes wherever you're resident, just because you are a US citizen. And it doesn't matter if you've not been there for 10 years, it doesn't matter if you are just a US citizen because you're a green card holder. Once you're a US citizen, you pick up certain obligations, and they're there with you for as long as you remain a US citizen or you're dead.
All right, thank you, Mr. Perryman. It's we've run into quite a bit of that as well. All right, and next on the list we have in cases in which U.S. nationals own shares in private companies, are corporate service providers under any obligation to report such holdings under FATCA regulations? And we'll take that one to Mr. Blum.
The FATCA regulations and most IGAs do require accounts of private companies that are controlled by U.S. nationals to be reported, but there are aggregate dollar balances that have to be exceeded, thresholds that have to be exceeded before that is the case. Also, corporate service providers who function as officers and directors are required to certify foreign financial institutions with respect to the identity of beneficial owners. So yes, there's certainly additional reporting requirements under FATCA that didn't exist prior to the law.
Okay, thank you, Mr. Blum.
Yeah, I think it's worth mentioning, Mark, that on the W8 Benny, when you go down to when you go down to the bottom of the FATCA reporting forms, there is that substantial shareholder. I don't remember the exact term right now in the Treasury form, but I think it says U.S. substantial shareholder, or maybe it says, yeah. So there is that question on the form for when you tick up top and you go down to the very last, right before you get to the perjury page. And since you said CSP, the CSP knows from their AML information, or should know, who the beneficial owner of the entities that they are serving as directors for are. And so if they have a bad W8 Ben or Ben E, old Ben or new Ben E, and they know that, again, in the future, there's a special place in hell for them.
That's interesting. We've run into several audits and compliance, and I'm a practitioner, so I'm actually meeting the IRS face-to-face doing these. And yeah, the special place in hell, I get that. That might be from some of the policy folks. And down in the trenches, what I've been finding is that a lot of the IRS folks that I deal with, this has been foisted upon them. And they may not know the first thing about international or FATCA, and now they're going to look at the manual and say, here's what we're going to do. And so if you've got a well put together case, we found that that 50% penalty comes down fairly quickly, and we've been able to ameliorate that down to generally $10,000 per year fairly quickly.
It's fair. It's fair. I'm talking about the counsel's office, and you've made an important distinction. There's a big difference between the line item audit folk and the prosecution office. There is a big distinction there. Should be.
But I do see it filtering down. So in the beginning they didn't know what to do with it. Now as they get more guidance, and so I understand that the IRS doesn't like that at all. And so it's good to know that they really are that upset about it up at the top, because it eventually will filter down. Okay, next. What if countries do not enter into an intergovernmental agreement or an IGA with the United States? What are the consequences for countries and institutions for noncompliance? And who would like to pick that one up for a show of hands? Anyone? Okay, Mr. Haydon Perryman's first up. Go ahead, sir. Everyone, if you could, when you're not speaking, if you've got the ability to do it, if you could, mute your mics because as it's coming across on the speakers, we're getting some feedback.
Sure.
Okay, go ahead.
Okay. So there are 112 tax jurisdictions which the US Treasury allows to be considered as IGA countries. There are only 73 IGAs that have currently been signed, but there are 112 jurisdictions that the Treasury allows to be treated as having an IGA in place. If you look at that in terms of world GDP, you would be above 90%. So there are something like 132 tax jurisdictions that the IRS recognizes that are still non-IGA, but in terms of world GDP, it's a very small minority. Okay, so that's just to put things in context. What are the consequences? Well, the IGAs for the most part negate withholding entirely. Okay, there are one or two exceptions to that, but for the most part they negate withholding entirely. So they take out a large part of the burden, and I would say that's the major consequence, I would say, withholding. Now, I know Professor Byrnes will have additional things to say on this because he often does when we talk IGA. So on that note, I'll hand over, Mark, to Professor Byrnes. I know he's got an opinion.
Okay, Professor.
So Haydon and I have been debating this, and it's very interesting debates because he's obviously coming from this UK continental perspective, European perspective, and it's not that I'm, pro-Treasury by any means, but on the other hand, I do see it in the shoes of my colleagues who work at U.S. Treasury, and from U.S. withholding agents' perspective, being that I am in the U.S. and live here. So the from their perspective, Treasury, speaking of, Treasury doesn't withhold, right? Anything. It's the withholding agents withhold. Treasury is just trying to enforce some code provisions that inevitably feed back into these revenue things. And so they make these regulations and practice notes, as Haydon might call them in the UK. These they send them down to the withholding agents, and now we've come up with this FATCA, and this is going to help enforce the whole withholding regime, which has had holes in it. We all, acknowledge that. It's just really a question of are the holes big or small. So let's bring it down to the specific question. If the holes were large, as U.S. Treasury thought, and I don't want to blame it on Treasury because this has been congressionally driven, and I do have several friends, colleagues, even alumni at Treasury who did not want FATCA. Who thought FATCA was a bad idea. It's going to overload the system with information they can't use, and the same as the credit card scenario did back a decade ago, as John Doe summonses. So regardless, let's just pretend it was Treasury's fault. And so Treasury, if Treasury was correct that there was this, let's call it $100 billion hole, whether it was from non-compliant individuals or non-compliant corporation withholding, whatever, what you would have is a major decline, by example, in U.S. Treasury note purchases from the countries that did not have IGAs, or, well, right now, withholding of interest on U.S. bank accounts now falls under Title IV, right? And Chapter 4, and because of that, anybody who has that U.S. bank account who has the interest being paid over last June 30th, or was it December 1st? Yeah, pre-January 1st, did not have that withholding, and then all of a sudden FATCA kicks in, they have that withholding. So you figure that the 140 non-IGA countries, which includes still some significant countries, would investors in U.S. Treasury bills or investors in U.S. bank accounts and so forth, like Middle Eastern countries, that they would have all withdrawn their funds. But that hasn't happened. And how do we know that hasn't happened? Because we can look at the Bank of International Settlements and we see that there has not been this massive outflow of capital from the U.S. So it leads me to believe either, number one, there wasn't all this noncompliance. Number two, that the people are still unaware and they haven't gotten a 1042 yet with a 30% withholding, so they haven't realized that the withholdings kicked in, and they're going to get an ugly, experience about 30 to 90 days from now when they finally get their withholding. Or number three, people aren't complying on the U.S. withholding agent side. Now, which of those three is accurate? I don't know, but it has to be one of those three. and so I'd like to hear what the practitioners think, or they think I'm totally off base and I've missed the mark, because sometimes I'm an academic.
This is Bill Blum. I think you're right, Professor Byrnes. My guess is a lot of them just don't know yet because they haven't paid attention, or haven't gotten the 1042-S yet. I'm wondering, though, how dynamic the enforcement mechanism is at the service, and whether people who discover that they've had this problem would be in a position to set up an offshore entity or a domestic entity, for that matter. Now, maybe the W-8 forms would require them to provide their identity and the fact that they are in a country that doesn't have an IGA, but I'm not sure about that. So it would be something I'd certainly think about looking into if a client approached me with that issue from a non-IGA country.
I can tell you that I've had several other practitioners call me here with this latest deadline coming up and asking me about what do we do with sending money offshore. We've got clients that have been doing it, and we asked them, hey, have you filed the 1042s and the 1042? And they asked me, what is a 1042? That's not a good conversation to have. And then once we explained, it's similar to the 941, failure to pay, failure to deposit, failure to report, and the penalties can very, very quickly run up to north of 50%. They were a little bit surprised about that. Go ahead, Professor.
I can tell you that there's some Model 2 FFIs and some South American, I'm not going to name the country, but there's some South American non-IGA FFIs who want to be compliant, and they're trying to use, and now, okay, I only know two of them offhand, but I know that these two institutions were trying to meet the deadline to translate their data into the XMS sheet that the IRS needs it in from foreign languages, mind you, because they're not English mother tongue institutions. So they're translating it, and I think they'd gotten that far, although there might have been some bad data in that conversion. But they were trying to upload it to the new IRS IDS system, the FATCA input system, and they were unable to do it. They were unable to get the. I'm not a software engineer like Haydon is, but they could. It wasn't the upload on the IRS side wasn't taking the information. I don't know what you call that in software engineering language, but it wasn't validating or whatever. Haydon can better explain it, but I know that as a fact was happening at least about a month ago when people were calling me asking me about like what's going on. I'm like, I don't know, call Haydon.
Well, I'll keep it brief. But there have been some jurisdictions where it has been very tough to register, even if you've got the very best of intentions to comply. Keeping it very brief, Mark, one of those jurisdictions would be Luxembourg, because the Luxembourg government doesn't have its own portal that's free like other jurisdictions. It's a paid service, and you have to go with FundSquare or Sophie, and that takes time to set up contracts, so on and so forth. Another example was South Africa, where there were some problems with the dating conventions in their instructions. If you followed their instructions to the letter, then you couldn't submit; it was invalid, and it got sent back to you. You didn't know why. So, I mean, Professor Byrnes is right. There have been a lot of jurisdictions that have made it next to, but not quite impossible to submit on time, even if you've got the very best of intentions.
Thank you, Mr. Perryman. We appreciate that. Okay, moving on to next on our list here. FATCA is a U.S. federal law. Are there any amendments being considered to this law, for example, to make it stricter? I know we've had the streamlined as one of the late amendments to the streamlined. I don't know about this becoming stricter. I do know that they've gone to automated reporting now. They brought a lot of the countries online. Do any of our panelists have anything to add to that?
This is Robert Ladislaw. I would just add that there are measures being proposed in Congress that it would make FATCA actually stricter and require more reporting. They're generally proposed by Democrats who are outnumbered in both the Senate and the House, so those amendments haven't gone anywhere for the past 2 years. After the next election cycle in 2016, who knows? I would think, I don't think anything would pass to make FATCA stricter, but in the political environment, it's hard to predict. You know, if revenue is needed somewhere, and if some measure is perceived as a revenue raiser, it's something that voters don't object to, and they can squeak by lobbyists. You never know when something might be passed to make it stricter.
And then I would add, on the flip side, you know, the Streamline program is basically regulation or an IRS pronouncement. So if the questioner was including that within his question, I think perhaps just the opposite. I mean, I think the IRS does consider this a work in progress, and is probably going to be looking at the numbers and the compliance issues, and if they're seeing that some of their efforts are not really producing any results, and maybe it's wishful thinking, and therefore just a burden, similar to the Streamline program, that, you know, maybe they'll back off and make the regs a little bit easier to comply with.
So Mark, if I could offer here,
Yes,
I think the American legislators often forget that it isn't America that's implementing FATCA, and that FATCA can't be implemented at all without other jurisdictions doing it for them. They also forget that there's virtually no money coming to them for FATCA, nothing like even a fraction of the 8.7 billion they promised when they passed Title V, when they passed the HIRE Act. Now, the US, all of the IGAs it negotiated, with the exception of 3 or 4, were all predicated on reciprocity, that the US shows absolutely no sign of meeting. I mean, far be it from me to say the IGAs were negotiated in good faith, but I mean, I don't know if anybody else feels differently, but I've seen absolutely no evidence of the US trying to make a reciprocal report to the IGA countries. And the other thing is that the US is the only member of the OECD that hasn't signed up to the Common Reporting Standard. And the IGA has also committed those nations to pursue the Common Reporting Standard. So the US doesn't make any money from FATCA, won't even make it stricter. If they make it stricter and try and raise more money, they can't do that without engaging other countries. And they haven't kept any of the commitments they made, either to on reciprocity, and they haven't entered the Common Reporting Standard. So forgive me, I don't want to get too emotional about it, but it's not actually America that's implementing FATCA, it's the rest of the world.
I'm not going to disagree.
I would state that the IRS is doing something, but it's going. I posted something in the last 30 days that the IRS believes that FATCA has already failed, and the reason, not the IRS but Treasury, the reason I say that is because Criminal Investigative Department, CID of Treasury, their chief counsel announced, and I roll my eyes because it's like, why do you need this if FATCA's working? But they announced they're going to do another John Doe summons, and so it seems that this is really going to happen in the next 60 days. They're going to John Doe summons using the correspondent account in the U.S. as the nexus to John Doe the foreign institutions or intermediaries to get the equivalent of W-9s from them, because you have W-8, you don't, who cares? So the W-9s from them, which, what do you need that if FATCA's working? But they're going to do this, and so just like the credit card dump from a decade ago, the John Doe summonses against MasterCard, American Express, Visa, and so forth, they're going to get another big, or they're at least going to request another big data dump, and so it's not an amendment to FATCA, but it's like another tool in the toolkit that they shouldn't need to use. That's going to be very inconvenient, considering that in theory that information should be provided anyway under the reporting dates that are coming forward.
All right, very good. Thank you, all gentlemen, for those comments. I've got comments from my clients in some Central American countries who have told me that banks are turning them away. They just don't want to. They don't want the expense, and they don't want to deal with it. So if you have a U.S. passport, please close your account. And if you don't have an account, please go away. All right, we're running. What's that, sir?
I'm sorry, I was just going to second that and say that many clients come to us with that problem. That is, their banks don't want them anymore. Can we recommend other ones? And a lot of times we cannot.
Okay. What's interesting about that as well is that I don't know whether you gentlemen on the call see it differently. I've read through these regulations a number of times, as I'm sure most of you have. I didn't find anywhere where it said you have to offboard Americans. I did find with the Treasury regulations where you have to close accounts if they remain recalcitrant and don't give you documentation. There was nothing about closing accounts to Americans. I think that countries such as my own banks, in countries such as my own, have misinterpreted the regulations and they're offboarding Americans when that's not a regulatory requirement. It's not the wisest thing to do. And with the forthcoming common reporting standard, where you have to report all jurisdictions, not just America, the corollary would be that you got rid of all of your customers. So all I can say is, from somebody who's working outside of the US, apologise for on behalf of all the FIs who've done that, because it's not what the regulation demanded. It has made a lot of Americans' lives a nightmare, and I think it was an unintended consequence of the regulation.
I think to some degree it's payback. I mean, Switzerland's probably a great example, and a lot of our initial efforts were in Switzerland, and I think some of the Swiss banks, and they're probably very close to the government there, basically said, all right, fine, so no Americans here. That's what you want.
And I also think to say it's unintended, I mean, that may be generous. I'm not convinced it was unintended. I think maybe when FATCA was passed, certainly none of the prime movers about legislation was concerned or would mind having U.S. persons being forced to close their offshore account, and in general, focusing specifically on citizens who reside abroad. Like we find here that politicians just don't care about that particular demographic. So if they're caught in the crossfire of this, so to speak, or collateral damage, they haven't been too worried about that up to now.
Okay, thank you, gentlemen. And to keep us on schedule here, I've got to move on. Okay, FATCA and your business. What questions seem to be most important to your clients about FATCA? Do they just seek your help in compliance, or are they also able to use their need for FATCA advice as a means to promote other services that you offer? And we'll go to Mr. Blum in New York.
Yes. Well, from a legal business perspective, FATCA has been a nice thing. People approach you because of a particular reason. Often it's a bank in outside the U.S. that suggests that they're going to have to close their account. But when they get here, we find that they've got other problems. Many of them, particularly those who've been outside the United States a long time, haven't filed tax returns. So, we certainly in a position to help them go back, usually 6 years to file past returns. So I guess at least from an individual perspective, the type of person or taxpayer is affected by FATCA also has some corollary issues. So we are able to provide additional services to them.
Okay, very good. Thank you. Anyone else? Anything to add to that?
Believe it or not, I get a lot of what is FATCA and how does it relate to or differ from the IGAs? What is the delta between FATCA and the Common Reporting Standard? How can we navigate that? Oh, and what's this thing? Have the UK got an equivalent? We do have called CDOT, Ground Dependencies and Overseas Territories. They're trying to work out what the heck kind of mess they're in with the FATCA and these related regulations and how to navigate them. And I tell you what, it's a mind-boggling, dizzying array of regulation. I often get questions about what is it and how do we navigate this.
Okay, we found similar in our practice. Okay, next we've got, based on your experience, do you think FATCA regulations are causing banks to be biased against holding accounts for U.S. persons? And I think we've already discussed that. The answer is yes. On to technical issues.
Professor Byrnes had a comment on the last one.
Oh, go ahead. Yes, sir. Professor Byrnes, did you have a comment?
I think that, so what's the business right now? And I think, so what I've been reading, and then Haydon just sent me an article like today, and I literally heard this issue last week from a tier 1 to an intermediary, and it's the chapter 3 versus chapter 4 issue. And maybe you're going to bring it up, so maybe I shouldn't talk about it now. It's just that there's a conflict between definitions, and a lot of financial institutions that have been accepting or even on their own behalf filing W-8s, because that's all there was, right, before FATCA, have continued to do that even though they're intermediaries, or they've avoided signing up for QI, because we know there's only 5,500, 6,500 QI, something like that. But now, with FATCA, it's all of a sudden there's like, oh, maybe there were people who should have been filing for QI who haven't been, like, maybe it's in the, I mean, you all tell me the estimate, but just today I read on this comment that Haydon sent me, it was like 40,000 maybe that should have signed up for QI, and that's a big difference. That's a lot of institutions. I mean, people have problems, but institutions have big problems. So that's, and I'm not talking about Switzerland, which everyone's focused on. I'm talking about some OECD member nations that are not on the radar screen for being non-tax compliant jurisdictions by any means, but they're institutions for ignorance or cost or whatever. They've been sending the wrong form, at least for the last 12 months. At least for the last 12 months. I can't speak about before that. Maybe they should have done a W-8 IMY, maybe, who knows. But I think that's going to be a relevant area for the attorneys who are here on the webinar in the future. I think institutions have to go back in time a couple years to kind of fix that, or at least file for new QI, because QI is still in place, right? So I think that's an interesting issue.
All right, very good. Thank you, Professor Byrnes. I can say that in practice with 1042S's year over year from 13 to 14, we've got a number of boxes, and it takes hours to understand and how you're going to fit your client into which box and to comply with it. And then year over year, one of my assistants said, "Hey, you're checking all the wrong boxes." I go, "No, this is how we did last year." And she goes, "Oh yeah, they resequenced all the boxes, and don't tell anybody." And I'm in the business, and good that she caught it. But if they could keep it consistent year over year, that would help. Okay, moving on. There's an interest in actual compliance at the institutional level to practical realities versus FATCA regulations. By example, are U.S. compliance officers following the language of the IGAs and following alternative forms to the W-8 series? I think Professor Byrnes talked about that. I see him shaking his head already. Would you like to add any more to that, Professor?
Well, ask Haydon, because he's living with this problem, but him and I debate this all the time. I know for a fact that the U.S. withholding agents aren't accepting. They'll accept a form that doesn't have IRS on the top of it, but other than that, no way. And I'm talking about the exact form. I'm not talking about you put the UK maybe domicile residence question, all that. It doesn't fit in their software, and it doesn't fit in their mindset. Okay, that's just my experience, and I'm talking to a lot of people, and Haydon and I have debated this, and I'm curious to hear what everyone else has to say.
Well, I'll come really briefly, if I may, Mark. So Professor Byrnes and I talk about this a lot. So we have spirited debates, and we respect each other's points of view, which are on this particular issue completely opposed. So I'm seeing my client not using at all now any of the W-8 series for onboarding because they're looking at the UK version of FATCA, they're looking at the CRS, they're saying, well, I can't send out a W-8 Ben for a, let's say, an NFFE because I need to establish not the US beneficial ownership, but the controlling persons because I'm in a IGA country, therefore I can't use the W-8 Ben as it is because that goes exclusively down the beneficial ownership route. They're also saying, well, but the CRS tells, and UK CDOT tells me that I have to capture all of the tax residences, whereas the W-8 only addresses the US citizenship. Also, the W-8s are written in American English, and I've got no issue with American English. But it's counterintuitive to our customers. So, for example, if you look at W-8 Benny, above section 1.5, it says check the appropriate box. Well, in the UK, you check all the boxes, but you tick or select the right one. It also says things like Chapter 4. Chapter 4 of what? You can't say Chapter 4 of the US tax code in the UK. Well, in fact, you can't say anywhere outside of the US. And so it really cheeses customers off. They're not tax experts, and you simply cannot use W8s in the real world outside of the US. Now, don't get me wrong, the US is the biggest country in the world, and Professor Byrnes makes an excellent point. All I would say is that those institutions up the chain that are used to getting W8s from their corporate upstream will continue to get those from us. What we're using them from in IGA Countries is with our retail customers, our smaller corporate customers. The whole infrastructure can work, but I don't mean to be rude to anybody, but the US tax code is the US tax code. It's applicable in the US. You can apply it where our FFIs had to sign an FFI agreement, so that's non-IGA countries, Model 2 countries, but you've got no jurisdiction in Model 1 IGA countries. We look to the IGA and to the statutory instruments that are promulgated as a result of those IGAs. And those tell us that a W8 is one form of classification that's acceptable. It doesn't force us down any particular route. So I respect Professor Byrnes enormously, but on this one I profoundly disagree with him.
All right, thank you, Haydon. All right, and we're running short on time, but we're going to finish up here with a bit of politics, and I'm sure this is a hot button item that could take several hours. Does anyone have any comments on Senator Rand Paul's FATCA lawsuit that's planned? And basically what he's doing is he's arguing that under the Constitution, Article 2, Section 2, that this FATCA agreement with foreign countries amounts to a treaty which was never ratified by the Senate. And it also, additional to that question is, in response to FATCA, last year we saw over 3,400 Americans give up their U.S. citizenship. It's 15 times more than what happened back in 2008, and I think we're only going to see that continuing to grow. Any comments on either one of those items from the panel?
Yes, sir. It's interesting that he brought that lawsuit, Rand Paul. Now, of course, he's running for president, so that may be the reason. But when the IGA started to be promulgated by the service, and the exact same thought occurred to me: well, what makes this different from the treaty? And I think, from a legal basis, although I haven't studied it heavily, that a very good argument could be made that these are treaties and that they are subject to ratification. But I'm wondering whether that makes all that much difference. Fine, so the Senate's not happy that they didn't ratify the IGAs. As long as the IRS is happy with them and the foreign countries have agreed to them, I'm not sure that they will have a practical effect. But I think technically he may be right.
Okay, and from a practitioner standpoint, I've got a question for the panel. This wasn't on the list of questions, but we've had clients who've been caught up with this, and they've settled with the IRS, not through OVDI, but they had their penalties. We argued it, and we got them down to about $10,000 a year for a number of years. And what we've seen is that IRS has been delegated collection enforcement authority, but has no enforced collection. They've been delegated collection. They've been delegated the administration of the FATCA project or program, but they have not been delegated enforced collection authority. So IRS can collect and seize your assets under Title 26 of the U.S. Code, but under Title 31, which is what covers these foreign account reporting rules, they cannot. And so the statute, I'm a little bit surprised, for collection from the time they assess the debt is 2 years. Have you all seen anything where clients are just slowly trying to slow walk this and run out the clock on the collection statute? Y'all run into this? Go ahead, Professor Byrnes.
Can you hear me? Did I turn it?
Yep. I can hear you. Well, now we can't hear you.
Now we can't hear you. We could.
I'm sorry, I'm not a practitioner, so I can't talk about my client base as William Blum can, and he's a very respected one. But what I heard 2 weeks ago at IFA, at the International Fiscal Association Congress in Switzerland, when you had the Treasury, the Swiss Treasury, and all these people together, was that on the collection side, which you just mentioned, you're correct. The IRS is having a very difficult time on the actual levying of the foreign assets. So yeah, I mean, you can always, of course, I'm not talking about Swiss banks and all that. I'm talking about individual taxpayers here. But yeah, you can say somebody owes you $1 trillion and solve the U.S. debt problem. Well, at least 1/17 of it. But you can't, if you can't get blood from a stone or water from a stone, however the saying goes. So yeah, I think it's relevant, but I haven't seen it in practice yet, the whole run-out issue, and I think that's interesting. I'd love to hear more about it.
Okay, and our time's up now. Any last comments by anyone on our panel? Okay, with that, I'll hand it back over to Matteo. Go ahead, sir.
Thank you very much for your participation, gentlemen. Marc, especially for deciding to join us the last minute and moderate. So you did an excellent job, and you actually covered all the questions, or most of them, which I'm quite impressed because there were a handful. Thank you, William. Thank you, Robert. Thank you, Haydon. Same to Professor Byrnes. I hope this was useful to you guys. Hope you enjoyed it. To the audience member, thanks for being with us. Again, we're going to send out an email tomorrow with the handouts. Professor Byrnes has a pretty big handout for all of you. We'll also send bios for the people who assisted. All of the info will be online on TaxLinked. We are going to have the recording ready probably within the next 2 days and load it. And feel free to share with your network. So with that said, any last comments? Any final remarks? Go ahead.
Best for our firm. Thank you, Matteo and TaxLink, for inviting us, and we're happy to participate.
Excellent.
I want to thank Deloitte because they're letting me use their offices. So thank you for their wireless. And obviously, I'm academic, not their employee. But number two, I just remembered a statistic. So the statistic is on the collections for these type of penalties, it's actually less than 45%, and that statistic is published in the TIGTA Treasuries, TIGTA. You'll see a post on it on my blog. It's the report in the last 30 days, and the report's in reference to how they're collecting against federal employees, against non-federal employees, but it applies to this situation. And against foreign assets, it's almost zero collection. So again, I don't know about the run-out issue, but I do know the challenges for the Treasury on collecting in general.
Okay. For my part, just amusingly going to tell you, in the UK, FATCA often is seen as standing for careful tax, colossal administration.
Good, I like that.
Excellent.
Okay, well, thank you, everybody. Look forward to our next webinar all together. Getting spirited debate.
We will plan that. We'll plan one, and we hope to have you all again on one of our webinars. So have a good weekend, end of the week. Have a good weekend, and we'll be in touch.